Thank you. Thank you very much, and thanks for the quick introduction, because I don't like long introductions. What's that?
There's a lot to talk about today.
Yeah, a lot to talk about. I got about 45 minutes of content, and I'm going to put it in 20 minutes, because that's my time, and leave time for questions. And I think the way that I would like you, so I was talking to Alex and Hannah and Carlos and Jeff, and this morning, what are you doing? How much are you raising? What are you working on? Why are you doing a startup? Where did the inspiration come from? And it's pretty varied, and venture capital is really specific. So I think I will talk about a couple areas. Ones are the patterns of success that I've seen in 20 years of why some startups work and then don't work. And then also some specifics on how to pitch for money that I think are important. And these are, I'm a framework person first and tips and tricks second. So if it tends to be conceptual, maybe too conceptual for you, now you know why. But it's very different. It's very, very, venture capital is such a myopic asset class. I'll get into it. It has such a specific, goofy corner case mandate that I'm going to work hard to try to relate to everyone. So my suggestion is, there's not a lot to take notes on. I'll make the deck available on the website because there are a few specifics in there. But just, if I can do anything today, I thought, if I can do a little bit of education, a little bit of inspiration of why it's an amazing time to do startups. There's a lot of cost curves and a lot of neat things happening, and why it's a great time to do startups. And then also, give some inspiration around that and some confidence in some things. So I will cover venture capital specifically, and there'll be kind of a downer moment in this presentation and then a lift up moment in this presentation. Okay? Like I said, we're going to get into pitching and presenting second, but I'm going to do patterns of success in growing companies first. And just so you know my background, I was in software and in some finance and in a bunch of what I would call myself, I was a lemonade stand entrepreneur. I was just trying to make a buck and not work for the man. And so that meant I tried to create a company, a wine import business, a radio station, a software company. And then I discovered when I worked for one company, it got bought for almost $1 billion, a large tech client server company by IBM, and I said, whoa, how did that happen? I got to find out. So post my MBA, I worked at Austin Ventures in the 90s, came back right here to Pasadena. I was the capital side of Idea Lab, for those of you that remember that brand. Had several funds with a firm called Clearstone, one of the earlier funds in LA. And most recently, a new $240 million fund that's been raised with March Capital. Also based in Southern California, though we invest globally in India, in Europe, in the US. And tech, I'm a tech investor. Also, some of my experience, who you're listening to, comes from 2 incubators we started in the Bay Area, more around enterprise software, enterprise networking, enterprise technologies. But these are different. They're not accelerators. They're not incubators. They're co-creation studios. They raise pools of capital, and I'm on the board of these, but my partner gets really the majority of the credit. We're starting the Hive, which is around big data applications, and the Fabric, which says if cloud's coming to networking, if cloud's coming to enterprise, here's the next 12 companies that need to be built. Let's just go build them. And it raises 10 to 20 million at a time to create 4 or 5 companies. So that's where my experience comes from, but it is kind of myopic on that. So let's set the stage for venture capital. I'm going to give you 2 slides today to let you know I'm not arrogant, because I'm very sensitive about being arrogant, because this is really hard to do, and I want to give a lot of experience. But I love my job. I would do it for free. I'm glad I don't have to. But I'm selling every day. There's this perception. I have the money. I sit back. The startups come to me. Just about every company that I want to put a term sheet into and invest in has 6 or 7 other VCs chasing it, a lot of the big Northern California names. So I don't know, when I wake up every day, I feel like I'm selling. So let's talk about this corner case of venture capital, right? Which is, I just raised this amount of money and I have to return that amount of money in about 10 years or I don't work again. And my money comes from institutions, from family offices, from pension funds. And so normally a VC might own 20% of a company, and if that company exits for $200 million, then I would return back to my fund $40 million. Well, 750 minus 40 means I have 710 more to find. So to get to the goal, we'd have to have 19 companies, and typically there's 25 a fund. Now, it's hard to believe that a fund could have 19 investments that are sold for 200 million, startups you invested in. That's a pretty decent sized number, and barely be acceptable. Out of 25, 19 are sold for 200 million. But that's the math I have to live with, and the picture down there is a grand slam walk-off home run. Or I could have one LinkedIn, right, that I am 4% of. And so that's my excuse of why VCs act so strange sometimes, and why they all act in a herd mentality and chase IoT or drones or autonomic cars or VR. Or I expect to hear, I'm the Pokemon Go for X at every business pitch, and I will the next 6 months. Because I've been hearing I'm the Uber for X, right? And so that's okay for venture capital, but there's a lot more capital out there. VC is a small, small piece, and it gets a large mind share, but it really shouldn't. Accordingly, I have to think about the exit from the moment I meet you and get involved with your company. And a company that's going to sell for 25 or 50 or 75 or 100, or I use the example 200, I can't invest. I cannot tell you how many amazing entrepreneurs I meet every week where they're giving me an opportunity to invest and I can't, and it's hard to explain. But I just can't get involved with the way my fund is structured. My next fund is going to be structured differently, and that's my secret passion is I'm going to try to disrupt venture capital with some other partners in my next fund. But exit is a function of engagement. That could be revenue. It could just be people using your app. The strategic value, and of course the growth rate. And I'm going to come back to the growth rate because it's important as we get into pitching. And then I want to make a point. When you take venture capital, and again, we're going to talk about other sources of capital and get into pitching, but when you take venture capital, you really are signing up to be an institutionally funded company. What does that mean? I use the Walt Disney example. Let's suppose by some luck of fortune, tomorrow morning you're the new CEO of the Walt Disney Company. Wow. Congratulations. Your first order of business is you notice the amusement parks are losing some money, so you're going to shut down the Walt Disney amusement park. You're not CEO 5 minutes later. You're really not CEO of the company, you're a steward. It's not owned by anyone, it's owned 93% by the public. It's owned by mutual funds and Fidelity and Janus and Vanguard. It's not the CEO's company. When you take venture capital, you're signing up to do the best for shareholder value. And that means it's not your company anymore. And there's a lot of companies I would not take venture capital because I want to run it. Because life's short and it's going to be fun. And I don't want to always have to optimize on that. But if you take venture capital, that's what you're signing up for. And the reason that I have a map here of San Francisco and all the high market cap companies in a small density area, like Cross Campus, like this event, they share patterns. And they've really got beyond this whole notion of my company, my company, my company. And I'm going to address something that's not on the slides real quick. Someone asked me this morning, do you want a business person? Hannah asked me about her healthcare startup. If you're not a good founder, you're going to get stuck with this company running it forever. And if you're really good and do a good job, you'll have the opportunity to replace yourself and have someone else who has incredible experience make you 100 times more wealthy. And you can go do another one while they're doing that, right? So that's the mentality that we really push our entrepreneurs to have. So now we're going to talk about the positive, why you must start a company. You have to, I love to hear about people starting companies, and no matter where they are in their risk profile of life, I think it's a good idea to start projects, okay? Right now, the cost of creating innovation has plummeted. Art's here in the room. He's working at a startup in my office that's raised less than $600,000. That's doing something really neat. That was not possible. It used to be $5 million to get going. Whether it's open source, whether it's AWS, whether it's working with developers offshore in a virtual environment, all the cost curves are in the right way. And if you think about the Fortune 2000, they're all stuck, and I'm hearing from them. They're all starting venture funds, including Home Depot Ventures. That's putting a lot of money out against Lowe's Ventures, Campbell's Ventures, JetBlue Ventures. Lately, we've taken all kinds of strategic investment. Look at their world. There's no more R&D. They can't hire good engineers. What good engineer who thinks their hot stuff is going to go work for the Home Depot in Atlanta? They're not going to do that. So they now have all accepted the mindset, I don't know if it'll stay, but I think it will, that they buy innovation. They buy innovation. Unfortunately, a lot of that is sub the numbers that venture capital can work with, but it's good for you. It's good for you. And just think about the Home Depot's business. It used to be corner location, lots of parking, big orange sign, a lot of stuff from China. That was the business model, cheap stuff, and aisles organized. Now it's, I got to track customers digitally for innovation. I have to compete against people buying stuff on Amazon Prime, so I got to start getting analytics and smart. And the stuff people want in the stores are the Nest and the Drop Cam, and I have to think about innovation and stocking as well. So it's everywhere. And then I want to tell another story of capital too. There's family offices globally, $1 billion here, $2 billion there, $3 billion here. There's pools of capital globally that want to get involved in tech. Microsoft went public at a $400 million market cap. Amazon went public at a $400 million market cap. Cisco 200, Intel 100. There was no reason to ever invest in a startup. You could just buy the public stock and ride it from 400 million to 100 billion, the 96% uptick. Those days are gone. If you're a pool of capital anywhere and you believe in tech and innovation, you have to put money into startups. And that's a very important point. And that's why it's never been, there's never been more interest in investing in startups. Another inspirational point, get on the balance sheet in life. I've talked to some people in this room about this. Most Americans experience wealth through their home and over the last 50 years through their mutual fund. But otherwise, we're all working on the P&L. We might be driving revenue for a company, we might be down the cost center, and I've been in both in my life. But starting a company, which doesn't mean you have to quit your job necessarily, starting a project, creating equity, getting a piece of a company is, I think, a fundamental change that's underway for more people. And I think more and more, certainly Americans, are going to be getting on the balance sheet in life. I'm going to skip some of this others. I'm going to mention one other thing. There was a study done of Nobel Prize winners in the sciences over a long period of time. The one thing they had in common was they started many more projects than their peers. So start projects. Okay, there's lots of sources of capital. There's angel capital. We talked about family office and others. I'm going to skip this one. This is why I think venture capital, despite how I've kind of picked on it, is very positive. So again, let's get to the pitch. I'm not a pilot, but I've been sitting in the control tower for 20 years. I do not know how to fly a plane. I do not know how to run a company. But I can say that one's coming in too low, and that one's coming in too fast, and that one's coming in offline, and that one's coming in too high, and that one's coming in just right. And that's one of the values that venture capital can add. I'm a professional pattern matcher. First mistake I see in some pitching. Entrepreneurs, I ask you to fight the urge to think, okay, I got my one meeting with my investor, and I need to be comprehensive. And I gotta tell him about this, and gotta tell her about that, and have to do all these things. Fight that urge. It's the most important thing. Be compelling. 12 slides. And I'm going to make an argument why it's better if you leave a lot of stuff unsaid. Everyone says, wow, a pool of capital meets 1,000 investments and only invests in one. What a horrible funnel. That's not how the funnel works for me, and it's not how it works for you in your life. Whatever you're doing, you're looking at some customers, you're looking whatever. The first thing I'm trying to do is say no to an investment. Oh, I do have a healthcare company. Oh, we don't do healthcare. And that's just because I'm trying to clear my desk at the end of the day and get home at a decent hour. So this is really how the funnel works, right? The most important thing about the first meeting is to get the second meeting. It's fine if someone says, well, tell me about your technology. You know, gosh, we're out of time. Let me cover that when I get back with you. A second meeting. The second meeting, I'm not on my own anymore. I've invited colleagues into the room. Might even be associates and analysts and interns. But now my reputation's on the line. What if I invited and wasted their time with a worthless startup? Suddenly, I'm your sponsor, and I'm your advocate. And you'll see this in meetings where suddenly the person who's bought in says, oh no, that's actually not what he meant. I heard this earlier. This is really exciting for these reasons. Get to the second meeting, because then it's 1 in 50. My big job is I'm trying to figure out every week, and other VCs are too, where I clear my desk and where I start to do due diligence and next steps. So, and I just think that's a better way to go. If you're designing a business plan, and some of you are, for different types of companies, this is a great framework. This is John Doerr's framework from Kleiner Perkins. You have product risk. You can build anything with enough time and money. That's not the issue. Does this set of people have their pulse to come out with the right features in the right time frame for the capital they have? That's what I'm trying to search for in your business plan. You have to talk about why have the right product for reputation management, why have the right product for these things, what the right features are. Market, know your market, who's failed and why, how is the industry organized? Management risk. I talked about the CEO and how you're going to hire a team. These are the things I'm trying to read in these 12 slides. And then capital risk, and that's more my job. If we have a perfect business with a perfect CEO and a perfect product and we give the company $5,000, we know how it's going to end, right? So that's to capitalize the company properly. I've used the word story a lot. Story, story, story. We're in Hollywood. This is your chance to be Steven Spielberg. Steve Jobs was a storyteller. Great fundraisers are storytellers. What's the story? What's the big idea? And don't waver from that. Admit that you don't know the stepping stones, but what's the big idea? And I'm going to talk a little more about this. So in the press right now, the big ideas are AR, VR, Internet of Things, autonomic cars. My big ideas are offline, online retail. Every retail, product retail, restaurant retail, service retail, especially product retail, is going to need to respond to Amazon and e-commerce. There's hundreds of startups that can sell into that market. I like the way marketplaces are developing, the way an enterprise brings an application to market. That's one of my areas as an enterprise software investor is changing, and I mentioned cloud. And then I have partners. There's 4 main partners and a whole investment staff, and everyone has other themes from gaming and some of these areas that are in the press. But you want to stick to the big idea, stars and stepping stones. I got my big idea, I got my vision. This is going to change. It might be 5 years, it might be 7 years, it might be 10 years. It's going to happen. I'm giving the pitch now. That's the star, but a star needs stepping stones and stepping stones need stars. I don't know how the stepping stones are going to go, but now the pitch is going to move into stepping stones. Today's most valuable new companies, if you think about them, the big market cap tech companies, the companies in enterprise software that have really changed in the venture world, so many entrepreneurs, especially ones who are technologists, are focused on the product. The product. You're trying to hack a new product. To me, the most exciting companies today are the ones that are hacking the go-to-market. LinkedIn found a way to grow a lot of engagement before it started to monetize. There's so many companies, Splunk and SolarWinds, for those of you that know enterprise software, that have gotten off of the old way of selling a model. Starting an enterprise software company and then go out and do a 9-month sales cycle. Start a content creation company and go out and have the same conversations. Find a way to be just as a creative an entrepreneur in that area. It's the go-to-market, because it's the fast growth that all venture capital is seeking. Doing okay? All right, I thought you were giving the high sign there. I like entrepreneurs and a lot of venture capitalists do who know your industry. How is it organized? Why is it organized that way? How many startups came along? Why did they fail? How are the budgets organized? What are the pressures on the industry? What's going to be happening? Why is this going to be accepted in this industry? I can't tell you how many pitches I go through where we'll be at the end of the hour and all we've talked about is, people will really use this if I can get it to market. Well, we know that. I knew that in 5 minutes. That's not the question. The question is, how is this going to be successful? Again, I can't do it. I don't know how to do it. I'm not a pilot. I'm just the guy in the control tower providing some runway for the company. Monetization deserves a special word. I believe engagement precedes monetization. If you don't have engagement, we're not going to talk about monetization. So why are we talking about monetization? On a consumer business especially, get to turn on monetization at user 1,000,001. I really believe in that, because that's a little bit of the San Francisco way of thinking or the Northern California way of thinking, but there is a reason that culture and that environment of startups dominates the really big tech companies. Even for B2B companies, I think it's easier to sell somebody and get money out of them than it is to have them use your product and come to rely on it to run their business. So think about that. Because I can have someone, I can fool them into giving me their money, but I can't fool them into coming to love my product. You're all the same way with apps you use every day. It's almost easier to pay for something and then get rid of it than it is to actually come to rely on one of the 7 to 10 apps that you open every single day. And so again, I really believe that model, and a lot of angels don't like that, because that means that you're going to burn a lot of money and they're going to get squeezed. And different sources of capital have different needs. That's not a one-size-fits-all, but that is a venture capital, I think, truism. If you're out to build that big company, because I'm not allowed to build small companies. That's why that's such an important point. How do you pitch? Here's the statements I thought of. Powerful in belief. I'm not coming off my belief. Offline retail has to change. It has to get smart. It has to Amazon itself. And I will not come off of that. How many questions you can rattle about my stepping stones, I will not come off of that. But I'm authentic. No one likes to be sold. You don't want me selling you something. I don't want to be sold. I don't want, gee, you never let him crack your confidence. I love answers like, I don't know. I think these are the first 3 stepping stones, but let's find it out together. I've never been involved with one startup, over 50 in my career, that has gone in a straight line. PayPal was dead. It wouldn't even do email. It was on a PDF device. GoTo changed to Overture. Cars Direct changed to internet brand. They all change. And so I'm really looking for somebody who can be an authentic thinker with me as we go through this battle together. And then another voice I like is colloquial. You don't have to make it a formal. I don't need a written business plan. I don't even like a pitch deck sometimes. Some of my favorites are, what do you do? You know what? I'm sure you've seen 10 pitch decks today. Look, here's the big idea. Here's how the industry's organized. Here's the kind of team I have put it together. What do you say? A couple $1 million? Let's go. Now, of course I'm not going to say let's go. But I wouldn't have said let's go after 75 slides and 90 minutes either. All I would do is conclude, so this is how board meetings are going to be the next 6 years. I'm out. Right? I want to have fun. This should be fun. It's hard work. It's fun. So you got to look at it like more real and less selling. And anyone who tells you, well, you got to say this, and here's how you overcome that objection, don't listen to that person. I know that's a really good question. And yeah, it does scare me sometimes when I ask a question I think is fairly obvious, or at least from experience, and someone looks at the ceiling and says, I never thought about that before. But I appreciate that than someone blustering and bluffing, and I'm kind of embarrassed. I hadn't thought about that. The reason I hadn't thought about it is because I thought that startup failed for other reasons, but you asked me a good question. Let me get back to you on that. Short answers. You all have in-laws. When you sit down with someone and all they do is talk about themselves for 45 minutes. You all have people in your life, and you know that when you ask them a question, you get a 30-minute answer, so you're not asking any more questions, right? So what do you think of this? I don't think it's a big deal at all. I think it's a non-issue. Does that answer your question? Just handle it like that, and let the person, and get them talking, right? The investor, that is. What am I evaluating during the meeting? I'm listening to what tense you're using, right? Are you talking about your product's great, then we're going to build? Whoa, you said your product's great. Now I'm listening for tense switch. So again, we got to get back to authentic. And what do I want most of all? Early in my career, I was guilty, and I had some write-offs for backing myself. And I still have write-offs. That's one of the great things about venture capital. It's meant to fail. If all of my startups are working, I'm not taking enough risk. And it's unique in that way, and great. But what I would say is that I'm evaluating, early in my career, let me finish that thought, I would say, well, this person can't really pitch very well. And this person's not really doing a very good job raising money, but I can help there, and is doing this wrong and this wrong, but I can help. And of course then, as CEO, you're a professional recruiter. You're recruiting capital, you're recruiting credibility, you're recruiting channels, you're recruiting customers, you're recruiting engineers. That's all you do is recruit. Recruit, tell stories, sell, get involved, inspire, and manage, right? And be thoughtful. It's a hard job. But if I don't feel sold in the first 15 minutes or 20 minutes, then I assume when you go to raise the Series B or the next round of capital, and I introduce you to my venture capital colleagues, the ones I built relationships with and I can reach out to, that they're gonna say no. So we've all been involved with, we being venture capitalists, in founders who are incredible salespeople, even if they don't follow up on other things. But they tend to get lots of capital for the company, which makes up for lots of mistakes. And so it's a really powerful thing to be able, that's why I go back to storytelling. Storytelling. I think I covered all this, and yeah, I did cover all this. And then you want to broadcast thoughtfulness. Are you networked? Because that's how you're going to hire engineers once I fund you, and hire channels and partners and recruiters and industry. So that doesn't mean you need to run around handing out business cards everywhere. It just means you reach out to people and you say, you invite them into your vision. You don't sell them. I need to do this. Just, are you interested? No, you're not. What about you? Are you interested in this vision? You aren't. Great. Get involved in my vision. Let me make you an advisor. Let me reach out to you once every 6 months and talk to you. What milestones? I'm raising $3 million. Why? Why not 2? Why not 4? I have no idea what the right answer is. I just want to see if you've thought about it. By the way, I don't put this in there. Plan for 18 months of capital. That's just a great thing. 12 is too little, 24 is too, 18 to 24. But if you think about, you get a certain amount of money, and you're going to run out of food and water at some point, so you need to get milestones. And I want to look at those and say, boy, if you get those milestones done, you're going to be able to raise money quite easily. I love people who broadcast to me how they're going to architect the company, not just the product and the market. By the way, today there's just 6 of us, and I'm Grand Poopah, but just if we get all this done in 18 months, I'd like to have a head count of about 25. This is what the org chart looks like. First thing I look is, where are you? And it might say, you might say I'm CEO if I deserve to be CEO. I may move to founder and chief product officer. But I'll always have a conversation with you. What I tell my founders I back is, when that day comes, I hope I hear it from you first. That I don't have to come to you and say it's time for you to get out of the way. I hope you come to me and say, you know, Jim, I've been thinking, when this company first started, nobody would come work for it because it was just nothing. And now, I think we're getting enough inbound, we've raised capital, we have customers, we have all this credibility. I think I can get this person who was going to go to Google, and I think they're going to come run this company in this space, or going to go to a big industry player, whatever industry it is. Turn it around. You got to evaluate your VC. I call it the great unlicensed profession. And a lot of my heartache I have on my portfolio companies, I'm on over 10 boards right now, comes from the way the bad actors of other investors. It drives me bananas. And I hope they don't say the same about me. And I don't think they do, because I really am careful about this. How do they treat you? I was recruiting a partner recently. 2 restaurant meetings in a row, they insulted the waiter. I don't need any more information. That's not a partner in March Capital. People who treat people that way, not interested. Do you get inbound references? I know when I'm trying to win a deal, and that's how I think about it, because remember, I'm selling, I call all of my CEOs and corp dev people and CEOs of big industry companies and say, I need you to make a call. Send an email. Tell them that they should be working with March Capital. Do they listen? Or do they just blow right through your comments? Are they connected in the industry? Are they fail? Are we going to have fun? Are you going to have fun and enjoyable? And do they understand what business they're in? Okay, there's the high sign. Do they understand what business they are in? Meaning, are they worried about every little risk? Well, what are you going to do about this? What if this employee wants $10,000 more? Really? That's how we're going to spend our board meetings the next 4, 5, 6, 7, 8, 9, 10 years? It takes that long if the company keeps growing. I think of all the companies we've sold early into M&A, early, or maybe than we wanted to, because we wanted to see it keep going. When I asked the founders 6 months, a year later, why they sold, they said, I hated my board. I hated board meetings. I didn't sleep the night before, I dreaded it. How are they conducting themselves in due diligence? And I know you have to have at least 2 before you can be, beggars can't be choosers, but build, if you have the chance, really evaluate your VC hard. Resources. For reading more about this, I think Fred Wilson's blog, there's a lot of bloggers out there, some are content free, these have content. Fred Wilson's very good, he's based in New York, I love his stuff. Brad Feld, who's out of Boulder, and he's involved with Techstars, he's got a book that's called Really Great on the Terms. I was going to cover that today, but there's not enough time. How to outsmart your VC on a term sheet, it's really good. And I think Ben Horowitz's book, it's really irreverent, and it's got kind of a vulgar voice that I don't truly appreciate, but the content's really good. It's called The Hard Things About the Hard Things, and it talks about a CEO that you never forget you're an entrepreneur and you find creative ways. Thank you very much.
excellent presentation. That was really inspiring. And I love just the candor and just the authenticity, like you said. I think a lot of people here that are considering venture capitalism, or venture capital, you can say, as a source of investment for their startups, can definitely find a lot of really useful information in what you said, and also learned a lot about the industry itself. We're going to open up to Q&A now. John is going to walk around with the mic. Questions now, if you have stories or comments that you want to share later, we're going to take that offline. Will you stick around afterwards?
I got to leave about, to get to a company about 10:15. So yeah, okay. I'll stick around half an hour, 45 minutes for sure. And I enjoyed the people I met this morning as well. And my email's up here, send it. I really work as hard as I can to respond to that. Some people reminded me I have not connected on LinkedIn. That's another work item now, but I'll do my best on email.
Awesome, great. If you have a question, raise your hand.
Jim, you mentioned this sort of dichotomy between angel investor objectives and VCs. Can you talk a little more, add more just detail about that and how to best strike that balance?
Yeah. I found that most first-time entrepreneurs, most not all, want to raise angel capital, not venture. And I find most people who've done a couple exits and startups now want to go for the billion-dollar company. They are different. It really I think the first analysis is you, why am I doing this, and what do I want out of it? And there's, by the way, if you're an entrepreneur that figures out a way to sell a company for $10 million and you own 40%, or finds a way to cash flow $1 million of money a year out of your business, honestly, you're my hero. I love it. And it's my biggest frustration with venture capital and what I want to change. So one, why are you doing this? What are you signing up for? And two, are you willing to go at and keep that big vision? You build a company very, very, very differently between the two. And so if you really want to lead with the big vision and try to get the best engineers and the best salespeople and the best biz dev people and the best product people and get the best customers, then I think venture capital can work for you. The one place it overlaps is some of the consumer apps sometimes start small and then they take off. Right? And suddenly they can be thought of in a different way. But I would say normally you architect it from the beginning. And then also really what you're going to sign up for on governance, because if a VC invests, it's not your company anymore. Think of my Walt Disney example. Angel is very different. It's still your company. You're going to make the decisions. No one's going to push you to go try to hire the number 2 person at Dell or EMC to come be the CEO, or Sony and Universal. It's different. It's different. And then the final thing I'll say is cash flow. The venture capital community believes, as I do, because I said it, that there's going to be a big J curve. We have to build engagement first. We want 30 million people using it or thousands of companies using it, and then we'll turn on monetization. Angels don't like that because that means more money. My model is I invest $2 million in a company, and if it works, I get to invest $5 million more, and if I get to invest $10 million more. And I'm trying to get $20 million into my breakout winners. I don't have to, but that's the preferred model. Angels don't think that way. They don't reserve $5 for every dollar they initially put in. Does that answer your question?
So you're investing pre-revenue or pre-market validation?
That's the only time people really want my money. Otherwise they can get other money. But yes, I invest pre-market validation, and those I actually think those are the fun ones too.
Over here, Jim.
Hey Jim, great talk. Can you share some stories around situations or cases in the past where your pattern matching, I guess, broke down, kind of your big misses that for some reason you decided not to invest, but it turned out to be
oh, I got lots of those. I mentioned PayPal. I'll say something again. It should have failed. It just, the product was so good it overcame awful mistakes by Elon, by Peter Thiel. I mean, just things you look at in the hindsight with the education of a high schooler and say, really? You really didn't realize eBay would carry this product? So again, there's the other sides too. Uber, I was driven around Uber by a guy in San Francisco who made me take it. He's the founder of AngelList, and he made me take it everywhere, and I just thought, my pattern matching said, from Cars Direct, which was just pummeled by auto dealers trying to sell cars across the country. And I just saw the cab unions and regulation and people safety issues. And I just, I never met the CEO, that's why I made a mistake, so it let me down there. Recently, I had a company that had my pattern matching around some issues early on with the CEO and CFO not listening. Are there any specific examples you're searching for?
Nothing specific, just kind of.
Let me think about some real big misses. There was. I think Ring is going to be a great company here in town for people who know the doorbell IoT company. I missed it. I saw it. I just feel like Dropcam was going to come on really fast, and they didn't. So they're normally around my industry analysis or my assumption of these days. They're around I miss the industry or I misread the people, and I always misread people on the high side, never on the low side, because I want to believe in people, and I think I can fix people and make them better, and that's when I get in trouble. You end up backing yourself. So those are my misses, if that helps.
Over here.
Hey Jim, I'm Aaron Fike. A lot of what you've been talking about has had a bit of a software bias, and I'm wondering if you have any thoughts on companies that are far more hardware-centric, particularly low growth hardware like energy or industrial applications.
I think a lot of Ring is a hardware company, I think, at least for now. Hardware commoditizes, so it's tough, right? I used to be a silicon investor. I used to invest in appliances, all in the cloud. I don't know any silicon investors anymore. Everything's done on commodity hardware and silicon. To me, when I'm interested in hardware, I'm interested in the brand you can build around hardware. So GoPro is hardware, and it's built a great brand. I think it was an obvious short from its ridiculous market cap when it launched, when it went public. But when a piece of hardware comes out, now Samsung and every other hardware manufacturer in the world says, well, we need an HD camera with this, and we'll release it for more. So there is a bias, right? There's a sense that software is eating everything. That's in all the big decks of Andreessen Horowitz. Or as all the networking folks say, everything's going soft, right? So it's hard, but to me, I get excited about hardware that can build in some sort of barrier once it's there. A consumer brand is a barrier. It could be some other functionality, but in terms of silicon, application-specific integrated circuits, in terms of hardware, I don't see that many issues. I've looked at RFID and chip and everything, or they become a real volume scale business where you have to believe that company, that entrepreneur, has incredible relationships where they can get to scale fast. But it does scare me a little bit, and yes, you're hearing that bias correctly. And that might be one I'm missing, and I know Pasadena's a hardware town. Or it used to be, yeah.
Hello, I'm Aaron Leader with W. I have a question. The main question is, what is your thoughts and the overall thoughts of the industry now, of Job Act's Title III?
Remind me of the details on Title III.
Basically, the Title III is basically the opportunity for crowdsourcing, equity crowdsourcing. Basically.
Right. So it's funny, I was talking to Marco about this here early this morning. I think it's wonderful if you have something that is a passion project and you're raising a reasonable amount of money, right? Marco is raising 25 to 50,000, and he's got a ton of followers on Facebook around his healthcare passion, and it's a really neat area and growing area of healthcare. What a great opportunity to go raise money. At its essence, what's neat about that model is how much would you pay to say you were the angel investor of Facebook? And by the way, you don't get your money back. But if I said to you, yeah, I invested 50 bucks in the crowdsourcing for Facebook, oh, they may have got me $51 back. So that's what you're tapping into. You're tapping into a large number, right, raising from, if I'm answering your question correctly, 10,000 people, raising $1,000, so a $10 million, or forget 1,000, how about 100, right, or 500, but raising an amount of money because they want to see that product come to market. I've done that, but it's not an IRR pitch. It's not, boy, I better get my 50 bucks back with return, and I want it to outperform my 1% yield I'm getting in my savings account, right? And so it's different, and I'm a big fan of it for the right projects. If you're doing a piece of enterprise software that's going to be, some DevOps piece of software, it's not going to work. But for a passion project, right? I would almost say the analogy is open source in the dev community, but I'm a big fan of it for the right profile of thing, right? But I really think it's tough to go to that market for a big dollar ask and say you're going to get a return, because they're just going to assume they're going to lose their money. So creating the narrative and the story again around the passion of why you should be involved and be able to pound your chest every day that you help this product that revolutionized this market, I think it's a terrific source for that. I've had a couple companies I've inquired to use it. None of mine have used it yet, but I've met many that have had a lot of success with it.
Jim, you mentioned the pattern matching, and you also mentioned a couple of companies, SolarWinds and Splunk.
Yes.
And another one I would think of is Atlassian.
Yeah.
How do you find companies that don't fit the pre-existing pattern? And none of those companies fit, I think, a pre-existing pattern at the time. I mean, Atlassian's a great example of that.
Yes.
How do you find those?
Well,
deal with things out of your pattern?
That's a big question. It's what we so here's how I'd answer it. We talk about that constantly in the firm. The next Google is not going to look like Google, right? It's not going to look like it. So I think you start one. I always think the most important words in any situation are Houston, we have a problem. I don't know any answers, but that's not going to stop me from saying Houston, we have a problem. We have a product problem. We have a management problem. We have a capital problem. So venture capital can't just do Me Too companies, and I try to avoid Me Too companies, really do. So that's one, and I think that's important. Starting with the problem statement that it's not going to look like. We believe what you just said. Two, we talk about it constantly, so maybe that's part of one. Two is we really try to push ourselves to be independent thinkers. And then for me, I map it back to who would love it and how fast will it grow. And that's why I give myself as an investor license to say, yeah, but what about the revenue model? If I get 1 million users, we'll figure that out. We may figure it out awful, we'll put ads on it. We may figure it out great. Everyone pays us $1,000 a year. But so we try to start with the most important things first. And I'm going to turn that around and say, if that's important to you, you better make sure your investor sorts on that. And not fake it in a meeting when they're under pressure, when that they really are independently thinking, saying, how I see that manifest itself best and most is people say, I can do due diligence on 100 things. What's your background, this, how much money you're going to, there's only 3 things that matter. What do you think about the market? What do you think about the product? And how are you going to go fast? So I like investors who can show that they're focused on the most important things about the most important things. I hope that answers it.
Jim, one last question.
Jim, relative to everything else you've mentioned, what's the relative importance of the ownership team? You have somebody come in who's just a founder, but then the next company has 3 co-founders, or you look at the existing ownership structure, there's multiple owners. Is that relatively important or not? And if you sense there's something to find out about, what's the best scenario where you have multiple owners?
Good question. Unimportant. Unimportant. If there's 3 co-founders, I start digging why. Are they all equal? Why did they do this? And that's fine. I don't like starting things alone. I have partners. If they're an individual, that's fine too. What's more important is what I said in the presentation is, give me a sense, any way you want. I mentioned org chart up here, on what you want this company to look like in 36 months. Another way an entrepreneur does that with me is say, I'll ask this question often. What are the companies you admire most and why? Oh, I admire this startup in town. I love the way the founder brought in the best people. Or I love Amazon because Jeff Bezos never gave up control and he had the passion. I like that too. I mean, we've got a lot of great companies like that. I try to avoid lottery ticket thinking where you apply the outlier. But whether it's a single founder or a group of co-founders is irrelevant. What I'm looking for is why and where is it going to lead me. That answers the question. Thank you very much, and I'll be hanging out a little bit. Thank you.